after finishing this IFRS impact on the balance sheet items, let us check how the IFRS will impact the major item of profit or loss account, that is revenue standard, that is revenue recognition. In profit or loss account, major part is revenue recognition. SOCPA was also having some standard for revenue recognition, which was emphasizing more on on transfer of title of goods or on transfer of position of goods for recognizing a revenue. But IFRS 15, which is recently issued by ISB, provides 5-step model for recognizing a revenue and provides detailed guidance for recognizing a revenue. Now, what are those 5-step model for recognition and measurement of revenue? Step 1 is that before recognizing any revenue, you first identify a contract with the customer. Then step 2 is identifying a performance obligation. Performance obligation is nothing but a promise made to the customer. That promise can be through brochures or that can be found out in a contract, written contract, or that can be a customary practice also of the business. So you have to identify performance obligations or promises in such contract. Then you have to determine a transaction price for such promises made to the customer or performance obligations. Then you will have to allocate a transaction price to each performance obligation. And then as and when the performance obligation gets satisfied, you have to allocate or recognize the revenue. Now this revenue standard itself takes a lot of time to explain because it is very much detailed, but I will try to provide you the brief of the standard along with the possible impact on the revenue or P&L. So along with example, I will try to explain you in brief how this standard will have an impact. So as I told you, in step 1 you will have to identify a contract with customer. That contract can be oral or written. Step 2, you are identifying a performance obligation or promises. Now if I want to give you an example, for example, a consumer durable company is selling a TV. Now along with TV, company is giving AMC services for 3 years. So now in this contract, company is providing 2 performance obligations. First is sale of TV and second is AMC contract for 3 years. So you will have to bifurcate this performance obligation. Now as a step 3, you will have to determine a transaction price. Now company, generally in consumer durable service industry, company has a common transaction price for both of these. Now while selling TV, they will not provide you transaction price separately for AMC and separately for sale of TV. They will be having a combo price. So as a step 4, you will have to allocate these 2 prices to each and every performance obligation, and as and when the performance obligation of sale of TV will satisfy, you will recognize revenue related to that performance obligation, and as and when the AMC part will satisfy over 3 years, you will recognize revenue related to the AMC part for 3 years. Now as I told you that in many of the contracts, performance obligations would be separable, but transaction price cannot be separable. So that would become a challenge for the companies to identify this type of contracts, this type of different performance obligations, and then to identify different transaction price for such performance obligation. Now IFRS 15 also gives guidance on how to identify a transaction price for a performance obligation if it is not provided separately. Before that, let us look at how transaction price would be complicated to determine. Here IFRS 15 says that in case of variable consideration, you should use a probability distribution method to identify a probable amount which would be received, and that much revenue you should recognize based on that probability. There are 2 methods: expected value method, that is if there are large number of samples, then you will provide a probability for each and every sample, and based on that you will determine the expected value of the variable consideration, and that you will use as a transaction price. If there are less amount of samples, then single most likely amount. Say there are 3 samples, then any one which is most likely to happen, that you will select as a transaction price or variable consideration. Significant financing element you will have to remove. For example, you are providing significant financing to your customer. You are providing more than 1 year as a payment option to your customer, then of course there is a financing element involved in your consideration. So IFRS 15 requires you to bifurcate that finance portion from that consideration and show it as a finance income rather than an income from sale of goods. Now, as I told you, the allocation of transaction price to the performance obligation will be a key area or will be difficult. So what are the three methods available for identifying a standalone selling price for each performance obligation? So as I given you the example that if company is selling a TV along with the AMC service, both are different performance obligation, but they are having a one contract price. So you will have to first identify a transaction price related to the AMC portion, and residuary value would be allocated to the sale of TV. So for finding out a transaction price for AMC, there are three methods. First is adjusted market assessment approach. This means that you will find out the market price of this AMC in the market if provided separately. You will allocate this to the transaction price of the AMC, and the residual amount you will provide to the sale of TV. So in second approach, that is expected cost plus margin approach, you are not able to find out the market price of the AMC. So you will go and find out the cost of providing this AMC service, and you will add a margin to this AMC cost, and that after adding a margin you will be able to find out a transaction price for the AMC part, and then with a residual approach you can find out the transaction price for sale of TV. Now this bifurcation of transaction price between performance obligation is important because for recognizing a revenue, entity will have to satisfy performance obligation. If performance obligation is satisfied, then only transaction price attached to that performance obligation will be booked. So performance obligation can be satisfied over time or point in time. If customer simultaneously receives and consume all the benefit, if you are providing a professional consultancy service, in that case, you are as and when you are providing a consultancy service to the customer, he is consuming the benefit. So this is the type of overtime satisfying the performance obligation. Then if entity's work enhances asset controlled by the customer. For example, entity is doing providing some services related to the immovable property of the customer, then the entity's work creates immovable property for the customer, then this is the case of satisfying performance obligation over time. Entity's performance does not create asset with an alternative use, and entity has an enforceable right to payment work completed till date. Now in this case also, the entity satisfies the performance obligation over the time. So as and when the performance obligation is getting satisfied, the transaction price attached to this contract will be recognized as a revenue. But if by these three methods, if entity is not satisfying the performance obligation, then there is a point in time approach where there are some indicators like legal title transfer, possession transfer, customer's acceptance. These areas, the indicators are of transfer of control. Once there is a transfer of control, then at that point in time you will recognize the revenue. For example, in our case, when we are selling a TV, is a separate performance obligation, and selling AMC is separate performance obligation, though we are taking one contract price for both of it. So while selling a TV, it is a point in time contract where control is transferred, where legal title is transferred. So it is a case of satisfying performance obligation point in time. So we will recognize immediately the revenue related to the performance obligation, that is sale of TV. But sale related to AMC is case of consumer simultaneously receives or consumes all the benefit while you provide the AMC service. So that is the over the time satisfaction of performance obligation. So here AMC part is satisfied over time and sale of TV part is satisfied point in time. So sale of TV will be recognized in the first year. Revenue related to sale of TV will be recognized in the first year, but sale of AMC would be recognized over 3 years. Revenue related to sale of AMC would be recognized over 3 years based on the transaction price which we have decided based on any of the three methods, that is market assessment approach, expected cost plus margin approach, or residual value approach. So at the end of the webinar, I would like to tell you that what are the important areas which would be having impact while implementation of IFRS in Saudi Arabia. First area is balance sheet, property, plant and equipment, and other financial asset or financial liability items. And then as a new revenue standard is ready with us. So while adopting or while implementation of IFRS, this revenue standard will have to be considered. A possible impact of this revenue standard on profitability of the company will have to